Good morning. Mackenzie Johnston with Tri-State Livestock News, bringing you your Tuesday morning headlines concerning fair cattle markets. Sponsored by Sandhills Beef Company of Mullen, Nebraska. Eat like a rancher. America First means buying directly from the producer. Be the change. To learn about everything Sandhills Beef Company has to offer, head on over to their website, sandhillsbeefco.com. Wyoming Livestock Roundup has reported that commercial cattle manager and livestock market analyst for DV Auction, Corbett Wall, was recently featured during the Business of Beef Health and Management Summit presented by Beringer Ingelheim on February 11th, where he explained that the cattle industry is going into a supply trend that producers will like. The USDA revised 2019 cattle numbers down 620,000 head and the calf crop down 468,000 head to start off 2020. So now the cattle industry is working with a total inventory of 93.6 million head, which is significantly smaller than the 94.4 million head that was predicted. Due to this reduction, the industry is now facing tighter numbers of market-ready fed cattle moving into the second quarter of 2021. Because of this, producers should be able to gain some ground in the market and see increased demand for yearling cattle and calves. Increased input costs, such as corn trading well over $5 a bushel, is a situation that producers have not seen in years. China's increased interest in grain has more than overshadowed the lack of demand from ethanol plants, something that Wall describes as unbelievable. Another contributor to increased input costs is cattle carcass weights reaching 1,700 pounds. These increased weights have been good for grading, but the cost of gain is a large contributor to higher input costs, said Wall. As of today, the industry is looking at a finished fed cattle market right around $1.14 per pound, which can be expected to move into the mid-120s as we head into the second quarter of 2021. Feeder steers weighing 800 pounds are bringing right around $1.40 per pound. This price is expected to increase as we go forward. Late summer and fall contracts for feeder cattle coming off grass are expected to be in the mid-150s. This is a pretty good market, so producers who like this price should consider hedging or protecting this price, said Wall. Currently, a 500-pound calf is bringing anywhere from $160 to $170 per pound. As the demand grows for grazing cattle, these lighter calves have the potential to reach $2 per pound. According to Wall, the industry needs to have a healthy, competitive finished fed cattle market, and that has not been the case as of late. A large part of the industry is in corporate feed yards, and even smaller feeders have contracts with the packers. Wall said that the Cattle Market Transparency Act is still in the works, and this legislation would make it easier for smaller feedlots to get animals into the packer and help formulated feeders because it would increase the base price of cattle. Overall, Wall thinks that producers have things to look forward to because the beef industry has competition in the market and the supply of cattle is building demand. Meeting Place has reported that according to a report from the Honolulu Civil Beat, the Hawaii Senate Agriculture Committee is considering a bill that would challenge consolidation in the state's beef processing industry. The bill would impose restrictions on Hawaii meat on Oahu and Hawaii beef processors at Palau. Frank Vandersloot, an Idaho-based billionaire, leases both processing facilities from the state and controls 70% of the state's beef processing. Sounds kind of familiar. Even though Vandersloot has promised to increase processing capacity at the plants, the Hawaii government is pondering legislation that would limit how much of that capacity could go towards Vandersloot's brands. If the legislation passes, Vandersloot's share of processing capacity would be capped at 50%. Additionally, Vandersloot would be required to submit an annual report to the Department of Agriculture on his efforts to meet state goals on food security, sustainability, and safety. The remaining capacity would go towards other brands such as Panolo Cattle Company and Kwahili Ranch. CTV News out of Edmonton, Canada has reported that despite the Olymel pork plant in Red Deer, Canada being temporarily shut down, coronavirus cases continue to rise. On Friday, an Alberta Health Services official reported that 426 cases had been tied to the outbreak, up 83 from the last report that was released on Tuesday. Due to pressure from the workers' union, Olymel decided to shut the plant down last Monday. Because the plant has been idled because of coronavirus, the company expects the backlog of hogs to reach approximately somewhere in between 80,000 and 90,000 head. To address this backlog, the company is moving a significant amount of company-owned hogs to the United States to create enough plant capacity for all independent hog producers affected by the plant's closure. This transition is already occurring, and Olymel expects the backlog of market-ready hogs to be cleared up within 4 to 5 weeks after the plant is able to resume activities. Olymel has yet to report as to when the plant will be up and running again. That is all I have for you guys this morning. I hope you all have a terrific Tuesday, and I'll see you guys tomorrow morning.